You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by Tradier, a REST-based open and secure API for investors, advisors, and traders. Open a Tradier brokerage account and trade the way you want with competitive pricing and a unique API. Learn more at Tradier.com. And now, let's get you into peak options trading shape. It's time for Options Boot Camp.
Welcome back to Options Boot Camp, the program where we break down the sometimes scary, sometimes just obtuse, but always intriguing world of options and explain how you could use these crazy things in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network. If you're saying to yourself, wow, more Options Boot Camp coming my way so soon? Yes, that's the plan. Trying to hit you up, fill up your podcast device of choice with a lot more Options Boot Camp coming your way in the near future, and hopefully a more frequent basis, which is what you guys have been asking us for now for years. And joining me to help us do just that, our old friend, the black-hatted, perhaps black-hearted one, we shall see, Mr. Dan Passarelli, the author of a legion of options trading tomes and the founder of Market Taker Mentoring. Mr. Passarelli, welcome back to the show. Do you have your hat and whistle, sir?
I do, and I'm glad to be back, Mark.
I'm glad you're here, sir, because you have to help me answer some questions. It is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, this is how we're getting you more episodes here. You guys have inundated us. I feel bad, actually. You guys have inundated us with questions. We haven't been doing episodes lately, so I've been trying to filter your questions for this program onto the many other shows we do on the network, so you don't have to wait too long. But I know a lot of you listen to this show, and you want to hear your question on this show. Some of you only listen to this show. So we got to get you guys worked in here on this program as well. So, Dan, do you have your question answering pants on? Because we got a lot of questions. You ready to go?
Actually, Mark, because we're doing this on Skype, I wasn't aware that I had to wear pants today.
Oh, I forgot to give you the memo. Yes, pants are required. No pants, no questions here on the network. Thankfully, not a video show, so none of us have to endure that, listeners. Let's be thankful for the limitations of technology in this one. All right, here we go, Dan. First up, Steven Tresser. He says, Mark and Dan, I love the Options Bootcamp podcast and have learned a ton for you guys. Well, thank you, Stephen. Sorry we made you wait so long for your answer. He goes on to write, I have two questions about protecting profits with puts. Number one, I've heard you guys mention around 2% as the appropriate amount of premium to pay to protect profits in a stock. Is this 2% of the overall position or 2% of the profits? And number two, how this apply to profits in a long call. Let's say I'm up $10,000 in a long call position, and I think it still has some upward run. How do I figure out how many at the money or slightly out of the money puts I need to protect some percentage of this He says in parentheses, let's say 50 to 100% of that profit. Keep up. Thank you, and keep up the good work. Great show. Well, thank you, Stephen. Thank you for your question. I think we rotated you on to another show a few months ago, so you don't have to wait too long for your question overall here. Hopefully you heard that one. But Dan, this is a good question. This is kind of one of the perpetual themes of, how much does it cost to pay for puts? How much should I reasonably allocate of my portfolio to pay for this protection? So his first question is kind of the bellwether I've tossed out there before. I think you kind of backed this one up as well, which is kind of around 2%. It is a decent amount. Are you okay with that? And how do you view that as the overall position? 2% of the profits, A. And then B, in particular, he has this, long call position he wants to protect. How should he go about it? At the money, slightly out of the money puts. How should he go about protecting those gains, sir?
Yeah, so two different questions. I mean, the first one, when I seem to recall throwing out that 2% number, I think, a long time ago. But it was more of an observation that, if you're going to buy like a 3-month put or something like that, which I think is rather common for buying protective puts from a time horizon, a lot of times it can cost, maybe around 2%. I mean, sometimes more, sometimes less. So that's 2% of the stock value. And so am I good with that? Maybe. If I'm afraid that the stock could fall 3 to 5%, but I don't think it will, and so I still want to hold on to it, then to me it seems a little bit silly to spend 2%, to give up 2% of the value of the stock to protect, 2% or something like that. But if I'm really afraid of like a 10 or 20 or more than that move, then that can make a whole bunch of sense. Notwithstanding, of course, we can roll that into a collar or something like that also. So that's question one. As far as question two, how would this apply to profits in a long call? Say I'm up 10 grand on a long call position. I think it still has some upward run. How do I figure out how many at the money or slightly out of the money puts? So, I am a big fan of keeping everything as simple as possible. And while you could protect a long call position that has a profit and protect those profits by buying puts, I'm a big fan for just selling half the darn position, especially if the call's doubled or something in value, and then you're left playing with the house's money. Then you're not spending any more money on decaying assets, aka options, in this case puts, because you end up turning it into something different then. You end up turning it into a straddle or a strangle, which is a very different position than you started with. So I don't look at buying puts to protect a long call as a protected position. I look at that as fundamentally changing the position altogether that fits a totally different thesis.
Well said, sir. Yeah, and then that 2% position we've mentioned before, we've kind of thrown it out there because we get asked that question a lot, Stephen, about, how much should I expect to reasonably pay? I wish it was 2% of your profits. That would be a nice cheap put. Unfortunately, it's not. It's going to be 2% of that overall position. This is kind of a ballpark. Let's say you're looking out. I think usually when we throw that number out there, it's usually somewhere around a 3-month decent out of the money put, 5 to 10% out of the money. It's going to depend on the skew and the underlying, but general S&P, that's somewhere on the ballpark you're going to look at. And you might say to yourself, hey, that's crazy expensive. And you're right. That is crazy expensive, which is why we and so many people in the options industry spend so much time looking for ways to pay for puts. That's why the collar is so popular. That's why on our last episode, we did so many income components, because that's what people do. They usually, that's why we also say we structure that collar a little bit more efficiently, push that put out a little bit, maybe to 6 months. You're going to pay a little more. Sounds counterintuitive. I get it. But then it gives you time to set up that collar on the front month with the collar leg, short call. And you're also not going to pay as much on the put from a decay perspective. You really got a few months there before that decay really starts to impact you negatively. So you're collecting income. You're not really decaying on the put leg because you push it out a little bit. Over time, those two should come together. You could actually even collect money for it, or at the very least, you're not going to pay anywhere near 2%, which is the goal. at the end of the day. So, but straight up, you're just going to go out and buy a put. That's why we usually keep people in that ballpark. And yeah, I think Dan's right. I think selling that half of that position is a great way to go. Another alternative would be maybe just leg into a vertical. If it's run up a bunch, let's say you have that 50 call in XYZ everyone loves, and the stock's now at 60. Maybe you could sell a 55 against this. Now you got a vertical instead. You're taking in some money, maybe even more money than you spent on the initial call. So you're kind of okay there. And on top of it, that way you've mitigated some of your risk. And if it drops back down, it's dropped back down. But you've collected some money, taken some of that money off the table there as well. So that's another way to do it. I'm with Dan. Not big on legging into puts against the calls, and he got all sorts of funky things that you probably didn't plan on going out. Speaking of funky things, lots been going on in the other side of the derivatives fence, Dan, since our last episode. We've been getting deluged on questions on this. We got like 3 questions here, all on a similar theme. So let's just group them all together. First off, Jamalali. Let's go with Jamalali. They want to know, what are your thoughts on the chance of Bitcoin options listing in 2019? And then Money Train, he's obviously knows what's going on. He just sent in a comment saying, yes, finally. Bitcoin X, I think he means Bitcoin options. And then TLC, I kind of like that. TLC saying, haven't heard you guys chime in on the crypto derivatives front. Are they good for beginners, and which products do you recommend? Well, Dan, since the last time you and I have really gotten together on this program, a little show has snuck into our network called the Crypto Rundown. Hopefully you guys who sent these questions have been checking that one, because we've been hitting on that quite a bit. And you, Jamalali, and Money Train, actually very well timed on your questions. I'm sure they came in a while ago, but our answering now is certainly very timely, because just this past week on Friday, after much pestering on my part and indeed the part of our audience, the CME finally announcing they're going to list options on their Bitcoin futures. So yes, all of you who've wanted that, they've wanted an actual option. You said, yeah, the futures are cool, but we want an option to sink our teeth into. You're going to get them. Now, not tomorrow, not next month, not even this year, unfortunately, Q1 of 2020. So we could be talking another 6 months or so till the end of March. But they are coming. That's the first time you've ever heard that. So that's a nice thing. So I agree with Money Train. Yes, finally. Yes, I'm with you. We've been on that train for nearly 2 years now. I was giving SIBO a hard time when they had futures. Been giving CME a hard time. We want the options. We finally got them. Dan, before I get into this question from Tealc or TLC, however you want to pronounce it here, what are your thoughts on kind of the crypto? If he wants to know, are they good for beginners? I'm sure since the last time you and I have gathered together, you've had some of your mentees come in and ask you about this. What are your thoughts on the space? If you have any, which products do you like, and what about the options?
Well, I mean, cryptocurrencies are very interesting. They are an asset, and I have to qualify that by saying I use the term extremely loosely in this case, because they're really not an asset. They're something that doesn't actually have any utility, and without utility, there can be no value, So, I don't know. I mean, I'm not trying to get too, philosophical or anything here, but you can't really buy a lot of stuff with cryptocurrencies. So I don't know. They're interesting. Is it a great place for a beginner to start? Probably not. Something a little bit more tangible and regulated and understandable, like stocks, ETFs, I think are probably a better place to start. However, their existence as an asset is greatly benefited by people being able to protect themselves. So I am a gigantic fan, and I definitely applaud the CME Group for listing options on it so that people who do speculatively invest in it are able to do it in a smarter way and be able to control their risk, because, for anybody who's been following cryptocurrencies, they can be really, really volatile. So it's great to have the ability to protect yourself.
Yeah, there's a lot to unpack here. Again, I encourage you to check out our Crypto Rundown show. We've been doing that every week since the beginning of the year. A lot of fascinating guests. We've really tried to unpack the world of crypto derivatives for you guys. And a common refrain of ours has been, let's get the options going. Because I agree with Dan on a lot of that front. I mean, there are legitimate questions about most of these underlyings from an asset perspective. I'm not going to argue those. That's not my goal. But at the end of the day, you can't argue that they're tradable, which for a lot of people out there, that's all they need. They need a little bit of volume and a little bit of volatility. They'll make the rest work. And that's what we've got right now in a lot of these products. There is volume, there is volatility, and there are more choices for products and ways to trade them. The futures, the options. You're not just stuck having to use a VPN going through to Deribit, some international venue that's not regulated here in the U.S. And if they discover you're a U.S. resident using a VPN, they'll shut down your account. It's a disaster for a lot of people, particularly here in the U.S. Overseas, they're a little bit more forward-thinking on the regulatory front. Here, still a little bit slower. And so we haven't been able to have a lot of products to choose from. That's why having a listed venue like the CME offer products that have regulatory oversight, that have clearing. There's no counterparty risk. All the things that are terrifying in the world of crypto don't really have to worry about with these. You can still have questions about the asset and the underlying. That's a separate thing. But the product issues in terms of clearing and custody, all these things, not a concern over there at CME. Now to have the options on them, how great would it have been to have options on them when they went from 20,000 down to 3,000, then back up to 14,000, and now down to like 9,000. There's been so much movement without options. It's kind of been sad. But hey, we have them now. Would I recommend them as good for beginners? No, I don't think I would. I don't think anything on the crypto front is great for beginners. They're very nuanced products. Being able to execute is a much more of a chore than it is. You can't just, they're starting, some of the big platforms like TD and others starting to pick up and let you trade them, and Robinhood and others, but it still is a lion's share of work. You have to go set up a new account at a new firm like a Kraken or a Coinbase to execute a lot of these products, and the execution experience, quote unquote, is very different. You can't just hit a bid for any size. You have to, it's a lot, there's custody issues. You have to wait for your wallets to transfer. There's that kind of period of dread where you don't know if the trade went through. Are you going to get the funds? Are you going to get the assets? Vice versa. So I would not recommend them for beginners. Which products do I like? I think you have to just go Bitcoin for now. It's the whale. It's the lion's share. It's super dominant. It's a huge percentage, 65+% of all crypto market cap is Bitcoin. So stay with Bitcoin. That's where the liquidity is. You start getting further afield. I wouldn't go beyond the ETHs and some of those other ones that have a decent market cap to them. That top five, ETH, Litecoin, Bitcoin Cash, XRP, had a little bit of a bump lately, Ripple. But those don't even have options on them. So at least not in any regulated sense here in the U.S. So Bitcoin, the futures and the options if you're down with that, but I would not recommend them for beginners. And I'm excited about the options. We can keep going on that, but we got more questions. Great three for there from Jamalali, Money Train, and TLC. All right, next up here we got Scott. Scott Somer, he wants to know, if a calendar is too expensive, is the following a legitimate way to reduce the cost? And he puts a hashtag Amazon here, so he's obviously talking about Amazon. And he has a suggestion here, Dan. It looks like he wants to do the Ocnove 1795 calendar. Remember, a typical calendar, listeners, buying the longer-term contract, selling the nearer-dated one. He's saying if that's too expensive, what about this? And he has an additional leg here. So he's selling, it's like he wants to do a $60 out-of-the-money call. So he's selling the November 1855 call against that Nove 1795 call. So he's got a vertical he's buying there. Then he's turning around, instead of just selling the October 1795 call, he's buying that October 1855 call. So instead of just doing the calendar, Dan, he's legging into a calendar vertical, for lack of a better term. He wants to know, is this a good way to do it, or is there additional risk I'm not seeing? Dan, what do you think about him adding these two additional legs here to his calendar?
Well, hold on a second here. So basically all this is we're sure. Oh, I see. Well, I'm trying to figure out why someone would do this.
I had the same thought.
I mean, if the objective is just to find a way to make it cheaper, like is that because you've only got like a $3,000 account and you're trying to figure out how to make that one lot happen? Then you probably shouldn't be messing around with something like this, or put more money in your account, And to me, that would be the only rationale for trying to make something cheaper while adding layers and layers of complexity and really fundamentally changing the trade. So, yeah, I don't know. I mean, I'm kind of hard up to figure out why someone would do this. I don't know.
Yeah, I'm with you. I'm not a fan. You're selling that one upper leg, so that's reducing your cost, but you're buying another leg a little bit closer to home, so you're not saving that much money. So if premium, sounds like premium is your primary focus, you're not really accomplishing a ton with this. And there's a lot of other legs, there's commissions. I'm not. Maybe not even is there additional risk. I just don't see like Dan. I don't see the point. It seems like you're creating extra legs for the sake of creating extra legs. So yeah, Scott, Dan and I not a fan of this one here. All right, Steep 3. Let's go with Steep 3. Steep 3 wants to know: is it safe to say that most professional options traders are short premium and long theta? So short premium option listeners means you're selling options. Long theta means they're collecting time decay. Which can be your friend most? I think I guess that could be a fair characterization. A lot of professional options traders like to lean dark side. That's just the way a lot of them trade. Not all by any means, and I think we'll get to that in a future episode as well. But is it safe to say most? I don't know. A large percentage. I don't know if that equates to most. I'm kind of hemming and hawing a little bit here, Dan, because he's kind of on the line and kind of a little bit not. What do you think about this? Is it fair to say most quote-unquote pros lean dark side? What do you think?
I don't know about that. I mean, if we answer that question more broadly and say most traders and lump in every single market participant, then that answer is definitely not correct. Because if you look at implied volatility pricing over time, since the crash of 87, option implied volatility has been overpriced, meaning options have been overpriced. And the only way that happens, how does something become overpriced? There's more demand. People are buying them. So not selling them, buying them. So the market overall creates buying pressure for options. They're more long, if you will. So then we get to the question, is that what professional traders are doing, the smart money? And back about a year and a half ago when that one inverse volatility ETF went bust?
Yeah, it was February of 2018.
Yeah, okay. So when around the time that happened was one of the first times in history where you saw options not being overvalued anymore because there was so much professional money flowing in from the short side that there became no real point to being short options anymore. Something that in most eras of trading, you can't say. That's almost never been the norm until around then. So I don't know. I guess I'm just offering a whole bunch of color here to tell the story as well as I can. But I guess I didn't really answer the question, but hopefully provided a whole bunch more details to give you a little bit something to think about.
Yeah, clearly people, obviously, you just mentioned, there is empirical data that people actually buy options. Look at the volatility skew in the S&P, right? The calls are depressed and people are selling those, but people are also bidding up those puts. People are buying. Most large funds are selling calls against their long equity portfolio and probably buying puts to hedge, in which case they're doing both. So how do you equate them? Are they net short premium? Are they net long? Are they equal? There's a lot of wiggle room. I wouldn't say maybe most. I would say a large percentage of quote-unquote professionals, so asset managers, funds, they're in the income game. They want to generate income, and they're short. And also a lot of the former market makers and others, they like to lean dark side for a variety of reasons. But as we'll cover, I think, in a future episode, not everybody leans every way all the time. And certainly, most is obviously a subjective term. I don't know if I would go that far. A large percentage. Let's just leave it at that. Dan, that music means we kind of have to leave it there. Let's wrap it up with a real quick, easy one. Before we wrap up this mail call. Hope you guys are liking these boot camps, hitting your device on a more regular basis because we're liking bringing them to you. Let's go with an easy one here. This comes from Mark Boble. Dan, he wants to know, do you give credit spreads picks? Well, I do not. Dan, do you give credit spreads picks?
Yeah, we do that in our group coaching class. We do our daily group coaching class is where we give trade ideas every day, and We give trade ideas on credit spreads, debit spreads, time spreads, the whole shebang. Basically, John scours the market, finds the top trades of the day, and shares them with our students and shows them what they're all about and gives them a management plan.
Well, there you go, Mark, and anyone else out there who wants those picks, maybe some trading advice, maybe some help managing your options trades. Dan, if they want to learn about that stuff, where should they go? What should they do?
You know what? You can get a trial. I believe the address is markettaker.com/99, and we actually give you a 1-month trial for $99. So Market Taker, 2 T's in a row, markettaker.com/99, and that ought to get you to the $99 trial.
Markettaker.com/99. Don't forget the second T there. Second T for trading. On behalf of Dan and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending so many questions. We're going to try to do your mail call a little more frequently so you don't have to wait as long. Don't worry, we'll get to you. Keep them coming. We'll see you back here next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.